Welcome to Inside the Vault, Enterprise Bank's podcast series where we talk about items of interest to the small business community. Today, we're going to talk about business sales and acquisitions, which in our market area has become fairly prevalent. We have a lot of retiring business owners, and we're going to talk a little bit today about how deals are structured, the types of due diligence that are involved in business sales and acquisitions. And with me to discuss that is Michael Lamb, who's a friend of the bank. We've done a number of transactions together. Mike is a small business attorney, and I'm going to let him give our viewers and listeners a little background on himself and Lamb Law. Mike.
Thanks, Dave. Thank you for having me.
Sure.
I'm excited to do this. I've been a fan of the show for some time, and I'm happy to be on.
You're my first fan.
Nonsense. Just the first that said it. So my name is Mike Lamb. I have my own practice focused on small business representation and what I'd like to say is small business deal work. I've been out on my own for 4 years, been practicing for 17, spent a couple of years in-house as general counsel and running administrative operations for a client who then, fortunately for me, became my first client as I went out on my own. And I'm excited to talk through the M&A process with you.
Yeah, so I think we need to kind of set the stage first. When we're talking about small business M&A, it's a very, very different animal from large middle market or large corporate transactions. There's a lot involved beyond the numbers when it comes to small business.
I agree. I affectionately refer to it as the Wild West because every deal is slightly different. I think we play in what is defined as the low market. We can do deals that get into the 8 figures, but the vast majority of what we're doing here is $5 million and under. Mm-hmm. The structures change. The realities of each deal dictate how we advise, how early we have to issue spot, and simply we act more as a coach to our clients than truly just focused on, in my situation, legal issues.
Yeah, because typically, in the small business arena, this is, in most cases, kind of the first time for both sellers and buyers,
Yes.
Long time legacy family business or closely held business. This is a life-changing event for them.
And this is their baby that they've built and they've managed. And it's often difficult to let go. And it's difficult to understand some of the things that you have to negotiate and perhaps give away as part of the deal process. And same for the buyers. Often that's individuals that are trying to get into business ownership through acquisition. It's their first time. Everybody's learning the process together. And so that's why we as the advisors play a critical role in this space.
Now, you and I are kind of only a piece of the puzzle, and maybe not even in all cases, depending on whether financing's involved from a banking standpoint, but this is kind of a team effort, and we're going to talk a lot about the legal aspects and a lot about the financing aspects, but there's also kind of, normally a team around these types of transactions. I mean, you've got insurance components, you've got accounting components, you've got consultants and brokers in certain transactions.
Often, yes. Certainly there always needs to be a CPA firm involved, usually for both sides.
Right.
In fact, they're typically the first in, so to speak, on the deal structuring because, you may be second in, depending on whether there's a financing need to understand kind of how the deal pencils economically, which then leads to the business discussions on purchase price. And then usually I'm third in around the letter of intent phase, which begins to truly memorialize that the two parties are looking to roll forward together.
Right. So let's kind of eat this elephant as best we can from a flow perspective. So let's start with kind of the deal structure.
Mhm.
Then there's kind of two primary kind of methodologies to sell and buy a business, and we'll kind of talk about the pros and cons and the mechanics of both. So, we have typically asset purchases on one end of the spectrum, and then equity purchases, and there's some wiggle room in between that we'll talk about here in a minute. But when it comes to an asset purchase versus an equity purchase, can you kind of break it down in layman's terms as to how the mechanics and the structure differs between the two?
And there is a third, which is a true merger of equals. I think we see that less than an asset or a stock sale, but I'd say that the vast majority of the deals that we do are asset purchases from both the tax and the liability shield perspective.
So kind of let's be clear. Let's start with an asset purchase.
Yep.
So, in an asset purchase, there's basically two different business entities involved. There's the seller's business entity and there's a buyer's business entity.
Yep.
And what we're talking about is on the buy side, typically, unless it's a merger, a new entity or entities, depending on if there's real estate involved, need to be created.
Yep.
And that's kind of an easy legal maneuver
at the start.
Forming at the start,
depending upon the ownership.
Yeah. Versus an equity purchase, the business itself, the entity, the legal entity survives and basically just transfers its ownership, its stock or its membership interest.
Usually in the stock purchase, the actual individuals are the buyers of the equity from the individual seller. And then, yes, in the asset side, there's always a new entity being created that requires every administrative hurdle, be it EIN applications, Pennsylvania, or whatever other states you're doing business, state tax registrations, setting up bank accounts, transferring employees. It's a more involved process administratively on the asset side.
Yeah. But let's talk about the pros and cons of both.
Mm-hmm.
So let's go from the legal liability perspective.
Mm-hmm.
An asset purchase, typically the assets, with some exceptions, are being transferred. We call them free and clear. So you're not assuming liabilities of the existing selling business entity. You're whether you're as a buyer obtaining third party financing or not, you're basically getting clean assets. And
yes, in an asset purchase scenario, the liability risks are substantially less than the stock purchase, because really all you're concerned about are tax liabilities of the seller that were unpaid as of closing that do attach to the assets sold. In a stock purchase scenario, you're buying the business as it has operated from the outset, subject to all of its potential liabilities
Skeletons
for its
in the closet.
operations prior to closing. Correct.
So, which I would assume on your end as the attorney representing, particularly on a buy side, a lot more due diligence needs to be done
in the stock scenario.
On the stock scenario.
That's right. Yes.
And what is kind of some of those extra due diligence steps that you're looking at?
So I think it's focusing on taxes again, taking a detailed look into basically the entire open period for statute of limitations purposes, typically 6 years of prior returns, matching them to the financials for the same periods of time, understanding all of the liabilities on historical balance sheets, making sure that, in fact, there are no liens that are existing that need to be cleared. And then, lastly, you want to understand insurance claims, history, loss runs, and any existing litigation.
Yeah.
Including settled litigation that may have, let's say, trailing responsibilities per whatever agreement was entered into to conclude that litigation.
Gotcha. So let's talk a little bit about you mentioned it, employees. and personnel, which are in small business key to a
Often
successful
critical.
transition.
Yep.
So, in an asset purchase, which is what you and I typically see in our place in the market, you basically have to rehire everybody. You've got to you create new benefit structures, new compensation plans. So, talk a little bit about how the kind of the personnel, the human resource portion of the deal is different.
Well, every deal is different on that, because some buyers are actually buying the business to change the operating model and sometimes shed personnel.
Yeah.
Other times they need every single employee, which, as an aside, is actually a rather challenging issue to work through in the deal process, because when there are personnel that a buyer needs, they're going to build covenants to that effect inside of the purchase agreement, stating that employee A, B, C must sign on to join as a contingency to closing. You have to be very careful in those scenarios, because if the employee catches wind that that's in fact the case and isn't necessarily aligned with the seller entirely, the negotiations can get somewhat challenging, and the buyer can sometimes be forced to pay either more in just a base compensation or some type of retention bonus that perhaps they didn't want to, and then that shakes back to the overall economics of the deal. So employees are a critical component and can often introduce what I'd say as a late stage issue to a deal.
Yeah, because
so
typically it's all behind the scenes until
you want to keep it.
Yeah.
Usually the owners don't want to announce this to staff or to any third party, frankly, until they are well down the road of negotiating a purchase agreement and kind of knowing that the deal is likely to close. And so, yes, sometimes it's not even announced to personnel until days before closing, and then you're going through the negotiation process of trying to lock that individual up with buyer post-closing. Vast majority of the time that gets done, because obviously the employee wants to continue to work and is usually excited about the prospects of new ownership or whatever it may be.
Right.
But
so let's kind of jump into kind of the process. How does this typically, typically starts before you as an attorney are involved, but let's talk about kind of the first stages for you representing somebody, buy side or sell side, how you kind of
usually
the process.
I'm brought in after the business folks have discussed economic terms and are ready to memorialize a letter of intent.
Yeah.
Letter of intent is and should be whether you call it a letter of intent or a term sheet, it should always be in place, along with a confidentiality agreement if one wasn't already in place as a result of preliminary diligence that occurred to kind of align on the economics. But the letter of intent sets the framework and is the keystone for the deal. The vast majority of it is non-binding, meaning it's all subject to negotiation inside of the definitive purchase agreement, but it sets forth what's being paid, how it's being paid, what the critical conditions are to the deal. But the single most important piece of the letter of intent is an exclusivity provision, which is, going to usually be 90 days, sometimes 120 days, where the seller contractually agrees to not shop the business to any other party while the buyer is spending substantial time and money on diligence.
Yeah. And that's the key. I mean, there are costs to doing due diligence.
100%, and it's a massive time suck.
Right.
Aside from the costs, and now you need multiple professionals to get involved. It's a cumbersome process, but is an important process. And yes, there needs to be basic protections for the prospective buyer, that they are not going to get the deal shopped out from under them.
So that's kind of a big red flag for you if you have a seller not willing to give an exclusivity for a reasonable period of time.
Correct.
To a buyer.
Yeah, it's not worth pursuing and incurring the costs unless, in my opinion, you have that exclusivity.
Right.
Yeah.
So primary terms of the deal, signed off on a letter of intent.
Yep.
What's kind of the next step in the process?
Next step is more thorough diligence, which, depending upon transaction structure, can take a variety of paths.
Yeah.
It can be more voluminous, and also often a lot has been traded in advance of the LOI. And so it could just be focusing on contracts and, confirming financials and going out and checking inventory and looking at equipment and doing whatever the lender may need.
Yeah.
Is particularly if there's real property involved, because that adds a whole nother level of diligence, particularly if you have to get into environmental. But that's the first stage. And then usually the buyer nearly always controls the first draft of the purchase agreement. And that's because the buyer will choose when they're ready to incur the largest component of the professional services costs once they've hit a point where they feel that they're comfortable in diligence.
Right.
Sometimes that can happen very quickly after LOI because the parties have had ongoing discussions for a long time. Sometimes you truly need every minute of that 90 or 120 days to get through the diligence before you even start in on the purchase agreement.
Right. And, we deal with a lot, and I'm sure you do too, in what I call insider buyouts.
Mm-hmm.
Either key management personnel, an individual or a group of key employees.
Yep.
That is a little bit easier from the diligence perspective because they're already involved with the business, already a relationship between buyer and seller. It's a little easier to get information flowing in those scenarios.
I'd even argue that exclusivity is somewhat less important in those scenarios because obviously the sellers have, for lack of a better way to put it, groomed this level of management to take over and to be their succession plan. And this is the final step of the actual economic arrangement to make that happen. So all parties are usually rowing together far more in that scenario than unrelated third-party deals. But yes, it's important that in the insider buyout or the management buyout, you will get into sometimes the trickier component is actually the negotiations among the next group of partners as to management structure. Right.
Ownership percentages.
What does their governance agreement look like? Because often that has to be completely renegotiated. The legacy shareholder agreement for a corporation or operating agreement or partnership agreement for an LLC or a partnership often was set up for the former owners and now needs to be amended to put in place a new board, new decision-making authority, new governance structures.
Right.
And so that becomes a heavier lift than like the individual buyer buying out the third party entity who has less of a governance issue to be concerned with as part of the process.
Right. So, one of the biggest challenges with these small business buyouts is the quality of the financial information that's available. It's a little outside of your purview, but putting in a plug or a seed for any business owner that's looking to sell, get your financial house in order from a record keeping perspective.
Yep.
Put everything on the books.
Yes.
Because
you're never going to get the valuation if you're saying there's cash, right?
Yeah. And certain types of industries, that's a bigger challenge than others. But
Correct.
I always say, you want to avoid paying taxes, take that risk, but it'll come back to bite you when it's time to sell.
Yes. And obviously we never advise to take that risk, but it's a reality that we deal with routinely. And I'll actually add one more wrinkle, and that's deferred revenue, which
is a really important component in certain types of businesses.
Maybe we're getting a little bit ahead because that's kind of the working capital components of the transaction.
It's a good jump off to working capital. So let's talk about it.
Correct, because often a legacy small business that's been on a cash basis is probably, there's a chance that they're not even reporting deferred revenue internally or tracking deferred revenue internally appropriately, right? And so what do I mean by deferred revenue? Two easy examples. One would be, let's take a landscaping company, okay, that gets you on a subscription for their services throughout the summer and, maybe also the winter for snow shoveling or whatever. But they may invoice you for the full upfront cost in March and then owe you services all the way through the remainder of the year. Well, technically, a fraction of that amount is earned every month, okay, as services are provided. If I'm the buyer coming in and buying that business in May, 2 months in, with 7 months remaining, I expect 5/7 of what was prepaid to be delivered to me as working capital, and that is deferred
negotiated
revenue.
off the purchase price.
Or negotiated off the purchase price, but I need that actual cash
Right.
to go buy the inventory, to provide the services, to run the business. And so if it's negotiated off, now I'm having to inject the capital. Right. It can work the same way depending what I was bringing to the table. Same with annual software contracts. That's another place where we see this routinely when it's a software as a service business that's being sold. And so it's critical that both sides, and obviously you as the lender know this, and you're focused there too. Like, all parties need to align on not only the working capital requirement as a whole, but particularly the deferred revenue component.
Well, and let's talk about working capital, because obviously that's cash is the lifeblood of a small business.
Yep.
So, in an asset purchase, with some very rare exceptions, there's typically cash and even accounts receivable in a lot of cases, or money that's owed to the business, is not being transferred in an asset purchase.
That's right.
So, that's important for the buyer, whether it's from additional bank financing, additional equity injection. There's a capital need beyond the acquisition in an asset purchase, because you're typically not getting cash and accounts receivable, as part of the deal.
Agreed. And you absolutely must understand what historical average working capital is, because the 2 weeks or whatever your cycle is after you close, payroll is due.
Right.
And you need to buy all of your inventory if you haven't bought enough to run for whatever period of time. And so, again, every deal is slightly different. Usually there's some inventory that's purchased dollar for dollar. And often there can be a working capital requirement negotiated into the transaction, which, depending upon the size and complexity, you either agree on a number as part of the definitive agreement, and it has the effect of either requiring some cash to be left behind for that purpose or reducing the purchase price. In other scenarios, it can be a combination of cash and receivables that are not too old, right? That frankly, when I'm representing the buyer, I will try my best to keep receivables out of the working capital calculation unless they're really quick turnarounds, just because I don't want the risk of collection being shifted. But sometimes you can also do a working capital true up calculation that effectively says that we deliver a certain amount, but then in a period post closing, we actually have to do an analysis to determine exactly how much was left, how much, whether there's any kind of shortfall or excess, and then after a period of time post closing, the amount is either refunded or a little bit extra is required from the seller to the buyer. Yeah. Try to avoid that because it can get complex, and it's often a contentious post closing issue, right? If the parties don't align on the calculations, and so it just depends on the deal itself.
And that working capital component is also important in an equity deal. Yeah. Because, what I see typically is, a certain amount of working capital in an equity stock purchase or membership interest purchase, a certain amount of working capital that's necessary for operations transfers with the deal. But in a lot of cases with these legacy businesses, they're sitting on a lot of cash. Maybe they don't have any more debt. Right. So there's typically, the seller is going to distribute some of it either before closing or at closing. Mm-hmm. The key for us is to be sure, and a business valuation helps us determine this, what is necessary to kind of be transferred so that the business is healthy from a liquidity perspective.
Correct. Yeah. I mean, you being the lender often have a real part to play in that analysis and a requirement that you need to see, right? Or that you make up in, as you say, in the form of additional lending or even maybe a working capital, or excuse me, not working capital, line of credit,
Right.
tacked on.
Right. So we talked about LOI. We
Mhm.
talked about some of the due diligence.
Mhm.
When we get into a definitive purchase agreement,
Mhm.
what are some of the key factors?
Yeah, the definitive agreement is obviously going to memorialize the economics, the payment structure, but it's going to contain the critical components or representations and warranties of the seller with respect to the business and the assets. Okay, I'm not going to go into the weeds on that. I think that's a discussion I'm happy to have with anybody listening in detail if they'd like. But the reps and warranties are effectively the promises being made that the buyer is relying on to close the deal. And there are certain covenants that are also included, but both pre-closing and post-closing, depending upon kind of when. Often an agreement can be set up that it's just executed at the closing table, but sometimes you need to put an agreement, a definitive agreement, in place, executed prior to closing, and so that's where you can have post-execution covenants. And this is not restrictive covenants. I'll get there in 1 second.
Yeah.
Because the covenants and the reps and warranties lead you to the indemnification provisions of the purchase agreement, which are how we protect the parties from breach of any of those components I just mentioned. Be it, there's a tax issue that comes up post-closing. Okay. And the taxing authority claims that the seller owes X and is attempting to go after the cash paid to the seller for assets. Well, the seller distributed all of that cash out to the individuals shortly after closing. So now the taxing authority is coming after the buyer because the buyer now holds the assets, and the taxing authority's position is they have a lien on those assets. We would have had a representation within the purchase agreement that states that all taxes were reported and fully paid. And if it turns out post-closing that was not the case, now you have an indemnification claim so that the buyer is going after the seller effectively to cover their damages that the taxing authority is seeking. Indemnification is obviously a critical component. It's also heavily negotiated. There can be caps and baskets and escrow and seller notes that can be offset. There's various mechanisms to protect the buyer, okay, and to limit the liabilities of the seller. But that's really the meat of the purchase agreement: reps and warranties, indemnity.
And then you talked about
Restrictive covenants are a must-have, right? This is typically going to be a non-competition covenant, a non-solicitation covenant, non-solicitation of customers and vendors and employees, and then sometimes non-disparagement as well. And in the M&A context, restrictive covenants and more specifically non-compete covenants are, I would say, more enforceable than in a strictly employment context. Scenario. Now, in Pennsylvania, they're enforceable in the employment context and the deal context regardless, but you can usually get longer periods treated as enforceable and greater geographic restrictions treated as enforceable in the deal scenario because obviously I'm paying you for your business relying on the fact that you are not going to go and compete against me or try to steal the customers or employees or vendors that I have paid you for.
Yeah.
Right. So that's another critical component of the definitive agreement that's heavily negotiated.
Right. So we touched at different points in the discussion on valuation. Mm-hmm. So, at what point do you typically see valuations are necessary when it comes to third-party financing for?
Yeah, I was going to put it back to you.
A business acquisition. I mean, it's not an easy exercise in a privately held small business because owners typically mix their personal lives in their business to some degree. So there's a lot of you kind of got to look at a business valuation is based upon, the core necessary revenues and expenses of the business and what that translates to in terms of a return on investment to the buyer. And then, there's typically a multiple or a capitalization rate based on that most businesses kind of sell within. But, valuations are kind of also a third party, typically a CPA firm or a specialized valuation firm, kind of a validation of the third party that you're within a reasonable range. It's not a definitive science, but, that you're within a reasonable range. And I'm sure you've seen valuations can have a significant effect on the viability of a deal or the terms of the deal.
Yeah, particularly when the lender requires it and is only willing to lend based upon it.
Right.
And if the seller believes that it's incorrect, there's not much that can be done.
Yeah.
Right? Other than,
there's some
to what degree you're willing to allow the seller to finance a portion of it, right? Which is obviously going to fall into SBA rules, et cetera. But the valuation work is usually pretty early in the process, at least in my experience.
But it's a significant cost. It's part of that due diligence.
It is.
Cost. Yeah.
It's absolutely a significant cost, and it requires a lot of time on the seller's part.
So the other component is businesses need a place to operate.
Yep.
So we typically see two types of scenarios. There's some transactions that involve a real estate component, and a lot of transactions it involves leasing.
Yep.
So you can talk about some of the the due diligence steps and some of the process with regard to leases.
That's always going to be referenced inside the letter of intent.
Yeah.
Right. We're going to know what are their prime operating locations. Do they own them? Who owns them? Is it owned by the same seller? Often not. Often there's a separate real estate holding company that's owned by the same individuals that own the operating business. Sometimes that is negotiated to be acquired. Sometimes the seller wants to keep that real property as a passive investment going forward, and that works for the buyer sometimes. It's that has to start early in the process because, as you say, everyone needs a place to operate. And so if there's a problem with the real estate, there's a problem with the deal as a whole.
Yeah. And the other thing kind of related to needing a place to operate is you got to make sure on the buyer side that you have a good understanding of what your capital expenditures needs are going to be in the shorter term.
Well, sure. Especially, right. I mean, that's part of, if
due
you're
diligence,
buying the business,
that's got a significant physical plant. Yeah.
Correct. Now, yes, there must, hopefully there has already been, a CapEx plan in place that you're obtaining from the seller as part of diligence so that you're understanding what they foresee as their needs for the property, what, if any, cash they've had in reserve, which now there's a bucket of cash that's probably sold.
Yeah.
It's purchased, but it needs to exist because obviously that roof is coming or whatever the other major system repair that they foresee in their plans. So yeah, again, we circle all back to diligence.
Yeah.
And it just stresses the importance of it and the importance of being on top of all of these various components early and leading with the most thorough request possible.
Yeah. So let's kind of conclude with how these transactions are typically financed.
Yep.
So, I always equate it in a lot of these scenarios, particularly these insider buyouts, the key employees, the management team in a lot of cases, they've made a decent living, but they're not, significantly personally wealthy or have a lot of personal liquidity. So bank leverage, bank financing is typically a common component in the small business M&A world.
Yep.
Most of the value in a lot of these long-time legacy businesses is in the reputation of the business, the employee base, the intangibles.
Yep.
So you talked early on about goodwill.
Goodwill.
Well, goodwill is justified very well in a lot of cases by the profitability and the cash flow of the business,
Yep.
but it's not collateral.
Right.
So, while in the small business M&A world, conventional business acquisition financing is available, it's typically when the buyers have a lot of personal wealth, liquidity, or additional collateral outside the business, which in a lot of insider buyouts or family buyouts is typically not the case. So I know you've had some experience in near and dear to us is we use the SBA program a lot for a couple of reasons. One is the SBA guarantee from the government can mitigate a lot of the collateral risk in the deal associated with the goodwill. And they can also allow the bank to do a little higher leveraged financing than a typical M&A. So with your experience, I mean, outside of the SBA, which I don't do much of, the equity components for a buyer or the cash injection components can be fairly significant.
Absolutely. And it even in the SBA scenario, there's some level of requirement.
Yeah, 10%.
There could be mechanisms to reduce that to some small degree, but there's going to be some required skin in the game, so to speak. But yeah, in a traditional finance scenario, that's usually going to be even more than 10. You're going to see 20%. You're going to see. You actually often will see this shift sometimes to a seller finance scenario as well, because again, all depending upon how the relationship between the parties has gone through the courting and diligence process. But sometimes a seller just understands their prospective buyer very well and gets comfortable enough with them as an operator that they are willing to finance a portion of.
Plus, that can defer some of their upfront tax liability as well.
Absolutely.
The seller
100%.
Side.
And they're earning interest.
Yeah. Give you a little inside baseball. So, SBA requires a much more clean break than a lot of conventionally financed small business acquisitions, in that SBA will only allow the seller to be retained as a consultant, not as an employee. For a period of up to 1 year. And the inside baseball is the SBA experienced a lot of fraud with business owners that sold their business on paper but really didn't sell their business and kind of cashed out but were still in control.
Got it.
So SBA put some restrictions which are actually very advantageous for a smooth transition, but because of that fraud component, they put restrictions on it. They've also restricted, I think, which is a great tool in financing business acquisition, and earnout. So you want to talk just briefly about earnout?
Yes, so earnouts are where, again, when you have largely intangibles, and you're purchasing the business based on the likelihood of ongoing revenue streams and profitability, you can negotiate that little to nothing is actually paid to the seller at closing. And instead, so long as negotiated benchmarks are hit, be it quarterly or annually, whatever the parties agree to, only at that point in time is a portion of whatever's negotiated, be it a portion of revenue, a portion of net income, portion of gross profit. A portion of that is then paid to the seller for a period of years.
And it's going back to the same kind of thought process that SBA has on restricting the term of seller involvement in a business from an operational perspective. They also feel that earnouts create too much influence over the business by the seller.
Correct.
Because obviously they have a vested financial interest, but we're financing the buyer and the buyer's operational plan.
Correct.
So, all right. Great discussion. Let's kind of pull this all together. First of all, we talked early on, assemble your team early.
Always.
Secondly, this is not an overnight process.
No.
So, what do you typically see kind of as the timeline for a lot of these?
Months, usually, predominantly because of the diligence component.
Yeah.
But assembling. So to the point you made earlier about making sure. So if you're on the sell side, work with your tax advisors, work with your lawyers, work with your lenders early to set the business up for success when you are taking it to market, including the way that you have been recording various revenue and expenses, right? Once you're into the deal, same advisors need to be looped in as early as possible, because we each look at it from a slightly different perspective, given our professional services backgrounds, and we each identify not necessarily deal killers, but issues that should be addressed early. And so, yes, it's a lengthy process, but the idea is to get out ahead of the major problems early so that nobody spends too much time on a deal that's going to fail because of a particular issue.
Right.
And so the goal is to get it looked at early, discuss the big ticket items, obviously the economics, and then use the remainder of the time to focus on the more mundane but nevertheless important diligence in advance of the purchase agreement. Once you get the purchase agreement, you can move fast.
Yeah.
You know.
So you've actually put together quite a few resources for business owners that are interested. You've done a whole series of articles and blog posts. Can you talk about that?
Yeah. I wrote a 9-part series on the small business M&A process that largely summarizes or goes into a little bit more detail on the matters that we've discussed here today. And I think, I did it to obviously for marketing purposes, but also to just have a resource that spoke to the small business M&A piece. It is a very different world than a mid-market or obviously public company deal structures, right? There are methodologies and terms and purchase agreement structures that are understood to be the norm. That is less the case in the small business component. So the more that you can know about the process early on, the better off you are.
Yeah. How can our viewers and listeners access that information and contact you?
So the primary source to find me is through my website, which is mlamlaw. So Michael, mlamlaw.com. There's an insights tab that has all of the various articles that I've written, including a separate page dedicated to the M&A space. And I fully intend to put this video up on that page.
As will we on the bank's website for future reference. Mike, thanks so much for the information. Not an easy process, but manageable if you get the right professional assistance for both buyers and sellers. For those of you that have any questions or ideas for future episodes, you can email us at insidethevault@enterprisebankpgh.com. You can check us out on audio format on all the major podcast platforms and in video format on YouTube. Once again, Mike, thanks much for the info, and we'll see you on the next episode.
Thank you, Dave.